Hello, everyone. As a professor who teaches taxation, I get a ton of questions from my students and from people just like you. But there is one that comes up over and over and over again. It's that dreaded 15% U.S. withholding tax. It feels complicated, a little scary, and it can take a real bite out of your investment returns if you're not careful. So today, we're going to pull back the curtain on this thing and demystify it once and for all.
I've heard people call this a stupid tax. And you know what? I get it. It feels like you're just throwing money away for no good reason. And here's the hard truth. If you're holding the wrong kinds of U.S. investments in the wrong Canadian accounts, well, that's pretty much exactly what's happening. My goal here is to arm you with the knowledge to avoid that trap so you can build your portfolio the smart way and keep more of your hard-earned money working for you.
All right, let's kick things off with a little-known fact that might surprise you. The tax we're all so worried about, it isn't actually 15%. The default rate that the IRS charges any foreign investor is a whopping 30%. Think about that, 30%. The only reason we as Canadians get a deal is because of the Canada-US tax treaty. It's a special agreement that literally cuts that rate in half for us, down to 15%. So it's a huge benefit for sure, but it's still a cost we need to understand and manage.
So here's our game plan. First, we'll cover the absolute basics of what this tax is. Then, we'll dive into the two big scenarios. What happens when you buy US-listed funds directly, and what happens when you buy Canadian-listed funds that hold US stuff. Then, and this is the fun part, we'll look at some real numbers from real funds. And finally, we'll wrap it all up into a straightforward, tax-smart strategy that you can actually use.
Okay, let's jump into Section 1. We've got to start with the fundamentals. What exactly is this tax? And maybe more importantly, what does it apply to? I promise, getting this part right is the absolute foundation for everything else we're going to talk about.
So, in simple terms, a withholding tax is money that's taken right at the source, before you ever even touch it. Picture this. Let's say a U.S. company like Apple owes you a dividend payment of $100. Before that $100 even crosses the border into Canada, the IRS steps in and withholds its share. It takes 15% or $15 right off the top. So the money that actually lands in your brokerage account is only $85. It's an automatic slice taken out of your investment income.
All right, on to Section 2. Now we're getting into the nitty-gritty. Let's talk about the most direct way to invest in the U.S. You're going onto your brokerage platform, and you're buying stocks or ETFs that trade on a U.S. exchange, like the New York Stock Exchange or the NASDAQ. We're talking about buying shares of Tesla, or maybe that big S&P 500 ETF, VOO. The rules here are incredibly specific, and it all comes down to which account you use.
Now here's the crucial detail you have to remember. This tax is all about income. It doesn't care about the price of the stock going up or down. It's laser-focused on any income that security generates. So that means we're talking about stock dividends, any distributions from an ETF, or interest paid from a bond. All of that is on the hook for the 15% withholding. But, and this is the big but, the type of Canadian account you hold it in changes everything.
And this right here is probably the single most important rule in this entire explainer. The Canada-US tax treaty gives a special exemption to registered retirement accounts. What does that mean? It means your RRSP, your RRIF, and similar locked-in accounts are like a fortress. They are completely shielded from this 15% tax. But, and listen closely, the treaty does not view your TFSA, your FHSA, or just a regular cash account as retirement accounts. So if you hold U.S. income assets in those accounts, the tax man come it.
This leads us directly to something I call the TFSA trap. And believe me, it is one of the most common and, frankly, most costly mistakes I see investors make. Because the IRS doesn't recognize the TFSA as a retirement account, every single dollar of U.S. income you earn inside it gets hit with that 15% tax. And here's the real kicker. That money is just gone. Poof! It's unrecoverable. You can't claim it back on your taxes. You're basically choosing to give up 15% of your U.S. income right from the get-go.
Now, you might be wondering, okay, what about a non-registered or a cash account? Well, the story there is a little better, but it's still not a perfect solution. You can claim something called a foreign tax credit when you file your Canadian taxes, which is designed to give you credit for taxes you've already paid to another country. It definitely helps, but based on my experience and talking with many other accountants, it is almost never a full one-for-one recovery. It reduces the sting, but it doesn't eliminate the problem.
But it's not all bad news. For all you growth investors out there, here's a fantastic loophole. Remember, the tax only applies to income. So if you're invested in a US-listed growth stock, think Amazon or Tesla, that pays zero dividend, guess what?
There's no income for the IRS to tax, so there's no withholding tax. You can hold these kinds of stocks in any account you want, even your TFSA, without having to worry about it. Your tax-free capital gains stay completely tax-free.
Okay, let's shift gears. What if you're not buying stocks directly on a U.S. exchange? And let's be honest, a lot of us aren't. Many Canadian investors get their U.S. exposure by buying ETFs right here on the Toronto Stock Exchange. Things like VFV or ZSP, which track the S&P 500. This setup introduces a whole different layer of rules we need to unpack.
So here's the key distinction. When you own a Canadian ETF that itself owns U.S. stocks, you're not the one getting the dividends directly from the U.S. companies. The Canadian fund is. This means the ETF manager, think Vanguard or BMO, is the one who pays that 15% withholding tax to the IRS. It all happens behind the scenes at the fund level before they package up the money to pay you a distribution. It's basically invisible to you.
Now please lean in for this part, because this is the single most common point of confusion I see. Since the Canadian fund is paying the tax and not you directly, your RRSP's special tax exemption doesn't matter here. It's irrelevant. Even if you hold that Canadian ETF, like VFV, inside your RRSP, that 15% tax on the US dividends was already paid by the fund before the money got to you. You are effectively paying the tax by proxy. This is the entire core of that age-old debate about whether to hold VOO or VFV in your RRSP.
So that leads to a pretty important question, right? Just how much tax are these Canadian funds actually paying? And does it even matter in the grand scheme of things? Well, let's stop talking in hypotheticals. Let's get our hands dirty and look at the actual tax documents from some very popular Canadian ETF companies. This, my friends, is where the story gets really, really interesting.
And first, I want you to know that this isn't some secret hidden information. Any fund manager has to publish these detailed tax breakdowns. You can find this stuff yourself. Just go to their website, find the fund you own, and look for a link or a document called Tax Information or Distribution Characteristics. It's all there. Okay, let's look at some examples.
All right, take a look at this data from Hamilton ETFs. Focus on that last column, foreign tax withheld. For their EMAC fund, which holds U.S. energy stocks, the total payout was $1.82 per share, and the tax, less than 4 cents. For FMAC, it was 3 cents on $1.77. H-bond is a bit higher, which makes sense because it's U.S. bonds, but it's still just 7.5 cents. These numbers are, well, they're tiny. What is going on here?
Okay, was that just a weird one-off? Let's check another provider. Here's a few funds from Harvest ETFs, and we see the exact same pattern. Look at HBF. It paid out 75 cents, and only 2 cents was lost to withholding tax. HPYT paid out a massive $1.80 distribution, and again, only 2 cents of that was tax. The tax is definitely there, but it seems to have a surprisingly small impact on the overall payout. And now, this brings us to the final piece of the puzzle, the big reveal. Look at these 2 covered call ETFs from Global X. These funds are packed exclusively with U.S. stocks. But look at that last column, foreign tax withheld. It's zero, a flat zero, zilch. How is it physically possible for a fund full of U.S. stocks to pay absolutely no U.S. withholding tax? And here it is, the aha moment. It all comes down to how different types of income are treated. Under Canadian tax law, the money you make from writing covered call options, that premium income, is classified as capital gains. It is not considered foreign dividend income. And since that 15% withholding tax only applies to dividends and interest, this huge chunk of income from covered calls is completely exempt. That's the secret. That's why the tax hit on those other ETFs was so low. A huge portion of their payout wasn't dividends, it was these super tax-efficient option premiums. Wow. Okay, we have been on quite a journey. We've covered the rules for holding U.S. funds directly, the weird mechanics of Canadian-listed funds, and this really powerful exception for covered calls. So let's put it all together. Let's synthesize everything we've learned into a simple, actionable cheat sheet you can use for your own portfolio.
Here it is, your cheat sheet. 4 simple rules to live by. Rule number 1. If you want to own a U.S.-listed fund that pays dividends, like VOO, the best place for it is your RRSP or RIF to get that full tax exemption. Rule 2. U.S.-listed growth stocks with no dividends, like an Amazon, are safe anywhere, even your TFSA. Rule 3. For Canadian-listed funds that hold U.S. stocks, just know that a bit of tax is being paid behind the scenes. And finally, Rule 4. Canadian-listed covered call ETFs are an incredibly tax-efficient way to get U.S. exposure, thanks to that capital gains treatment.
And that really brings us to the end. The most important thing I want you to take away is that you are now in control.
By understanding these rules, you can stop being a passive victim of this tax and start being the active architect of a smarter, more efficient portfolio. So I'll just leave you with this one question to think about. Go and take a look at your own holdings. Now that you know how the game is played, is your portfolio set up to win,